Hey, good evening, everyone. It is the Tuesday, 28th of May, 2019. Let's do another video update. This will be on the blog, and at some point in the next week or two, I'll probably take the latest blog postings showing the greedometer sequence and mini greedometer sequence and move it to the newsletters behind the login. Probably will have a login in place probably next week. The latest probably the week after, so you will be able to you will continue to be able to see the greedometer 13 and mini greedometer 13 sequence and the SPIX forecast via the login. And so yes, I'll send out a note on that. And if you're visiting this website and you notice a week or two from now that, hey, where'd all these blog posts go with the greedometers? Well, they're behind the login screen, so you'll have the ability to create your own account and log in and see what's going on. All right, on with the show. So with this is a short week. With this, if we close, if the SPIX closes the week in the mid 2700s, and that's what's being shown here, then this week's greedometer value would look about like that. Now, per previous comments, there's about 200-ish. There's 1,000. That's about 1,000 spread from here to here. There's about 200, so a little bit, plus or minus 200 of wiggle room in this value because of the values estimated. Not all of the input parameters are known in the greedometer algorithm at this point in time, so some of them are estimated. These, when you go back more than a month, they're pretty much locked in, but the latest month and certainly the latest week has got a couple hundred or so RPM of wiggle room. Not that much, not enough to make really an appreciable difference. In any event, you can't see a whole lot from the greedometer sequence. It was birthing point there, and then whatever and dropping. Much more interesting is the mini greedometer sequence. So let's take a look at that. And there it is. There's the mini greedometer sequence. There's a birth point. There's the first top line point. There's last week's value now known. There's this week's value estimated. With this SPIX closing the week in the mid 2700s, it would generate, I estimate it would generate a mini greedometer value around here in value. And which, if that is the first baseline point, and it probably will be, that would generate a slope of, well, that, which would mean the SPIX story would look about like here. About a month or so would climb back up to about here and then drop to about here, 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 here. That's what the story would look like. Okay? Now, I got 20 years of doing this, and I've been watching central banks drop sugar bombs relentlessly and at a pretty regular and increasingly regular pace over the last 2, 3, 4 years. So do I expect our future to look like this? No, I do not. It is defensible and it is forecastable with some pretty decent high amount of confidence that this is what our forecast would look like if there is no China-US trade deal, and if central bankers sit on their hands and do nothing. And when they haven't done that for the last 20 years, so will they do that for the next few months? No, they will not. Somebody will blink, and they will do all sorts of goodies. We already know the Fed will, in September-ish, stop its quantitative tightening, so there's that. That's baked in, so that's not going to change it. However, increasingly the Federal Reserve is being pressured and expected to begin dropping interest rates. So it probably will begin hinting at that and threatening to drop interest rates probably as early as next month, June. It could be as late as July. So they'll probably begin telegraphing that. It'll be awesome to see this week close unfettered by central bank sugar bombs. Why? Because that gives us a firm point from which to push off from which to warp the sequence flatter as central bank actions, as central bank sugar bombs are threatened and then delivered. So I expect sometime over the next 1-2 months, the Fed will begin telegraphing an intent to dropping rates, and then sometime by probably August, it will begin dropping rates. And so when it does, that will warp whatever we see in terms of a first baseline point, and probably this week, probably something like that. This flatness, this baseline, will get flattened, a little bit from the Fed, threatening to drop interest rates, and by the time it does, like I say, August, maybe September at the latest, then there will be what will be baked in is not a one-off 25 bip based drop in the Fed funds rate. No, what will begin to be and increasingly will be baked in to the forecast will be the Fed continuing to drop interest rates down to zero by first quarter next year, right? Start in, say, September-ish and finish in March-ish or so of next year. So this probably won't be our future. This will, if no one does anything, and look like that. And then we get warped flatter and flatter and flatter and flatter. Ultimately, I think the end point, the end of this story is going to look a lot like that. I think we'll end up with a baseline around here-ish, plus or minus a certain amount of wiggle room, right? I think the end will look something like that. And the top line will look something like that with that kind of a spread, that kind of a gap. Why? Because, because there's been an awful lot of central bank sugar bombs and warping of the sequence for the last so many years. We've had nothing but that, so we should expect more of the same. And second thing is, as sort of a reference point, the black line is the baseline from the crash of 2007-8-9, and no sequence has had a baseline anywhere near that flat. Everything has been far, far steeper. So I expect this to start out being steeper and be warped flatter and flatter and flatter and flatter by the Fed, stopping QT, dropping interest rates, and then at some point in time, when the mini greedometer values are probably around 20 or 15, so that's 25 there, so 20 or 15 or so, when and if they get that low, the Fed will then probably blink again and threaten something new and epic. It's done QE 1, 2, and 3, and it's obvious to everyone that that doesn't solve the problem. So they need to reach into their hat and convince everyone they have some new howitzer, some new bazooka, something that's going to actually solve the problem. It won't solve the problem, but in the near term, and by near term I mean the next 1, 2, 3, 4 years, it may buy that much time. It may kick the can that much further if they print several $trillions and directly deposit that into people's accounts. That'll be pretty damn massively inflationary. Will it solve the problem? Almost certainly not. I doubt at this stage monetary policy alone can solve what ails the U.S. economy. There's structural inefficiencies and structural problems, and internationalization or globalization and aging workforce, and of course bots and algorithms and taking over people's jobs. Nothing you can do about it. It's the way things are going. So some form of free money is where we're going to end up. And it may well start off with the Fed. So that'll probably begin being threatened by the Fed in the end of this year, Q4 at some point. And then it'll probably actually be delivered, because that'll be massive. That threat will be massive. It'll to a long extent it'll go a long way towards flattening the baseline, very, very flat. Maybe as flat as that. Could be. I don't know. I doubt it'll get that flat, but certainly something like that. Then we get to the election, and who knows who wins? Who really cares, red or blue? The same crap happens either way. So, in other words, a complete lack of fiscal discipline. Red and blue. So, I get it. Look, everyone watching this is fairly dogmatic. They've always voted red. They've always voted blue, and the problem with that is you discount your vote, don't you? But anyway, I'll get off my soapbox on that one. So we'll get the election November of next year, and then depending on who wins, certainly if the Democrats win, then I would look for I would look for that to happen. Okay, if the Republicans win, then I would look for markets to rally again, because there's probably going to be some wildly stupid unfunded tax cut, which won't solve a problem, because it never has, certainly not in the last 30 years or 40 years that I've been paying attention to the economic situation in the United States. Yes, all the way back as far as Reagan. Mr. Reagan. He is, by the way, the person who initiated the great and epic debt to GDP explosion in the U.S. So before you go too far, remembering the fond days of Mr. Reagan, he is the starter of that, and everyone that came after him followed suit. Anyway, So that's what our future probably looks like. If no sugar bombs and reality happens, then that's pretty crappy. That's what our future looks like. And there probably will be sugar bombs and threats, and so it'll get pushed and pushed and pushed and pushed, and to look something like this. And I expect something epic to be done and actually delivered. Now here's the problem. Let me talk about this. Central bankers are loath to do big and new things anywhere near before an election, because they'll be obviously accused with messing with the process and changing the outcome. So there'll be an awful lot of pressure on the Fed to do nothing next year. So, but that being said, let me see what happened in 2008. The sky was falling, and they did all sorts of things in terms of bank bailouts, and announced, and then started with QE1. So if things are sufficiently scary and crappy enough, then they will do something. So maybe this gets pulled forward in time to like Q1 or Q2, because that's further away from the election. That's the reason to do that. Anyway, but that's probably what our future looks like, something like that.